FX Street on our regular Monday morning, depending on where you are in the world, Monday morning for me. For the people at FX Street who host us, it's either afternoon or evening, depending on where they are. Some of them are in Barcelona, some of them are in Miami, and some of them are in Indonesia. We have a worldwide web here of our own every Monday. Today's topic is, the title at any rate, is the Fed tightening rates. And in one sense, of course, it's basically an oxymoron. Not quite, actually, but close. If the Fed is tightening rates, then the Fed is tightening rates. Meaning, of course, if the rates in January were 0.5 and the top of the target, 0.75 and the top of the target range is now 1, then the Fed has tightened rates. And if, by the way, if anyone has any questions or comments or anything else they'd like to add, please type it into the FX Street video chat and I will see it. I have it up and I'll be glad to talk about whatever you'd like to talk about this morning, in addition to the prescribed topic we have here. Also, I'd like to apologize in advance slightly. My information system was a bit recalcitrant this morning, and I could not get up as many charts that new charts that I wanted to, so I'm forced to use a few charts from my webinar last week. However, they are fortunately very applicable to this particular topic today. So if the Fed is raising rates, then by definition, the Fed is tightening rates. Seems kind of silly, but of course it's true. By the end of this year, it's very likely that the Fed funds rate will be double what it was at the beginning of the year. Now, as you can see, let's take a look at this, okay? This is a better chart of the Fed funds rate and US GDP. So let's look at this one. This is actually from last week. But luckily, the Fed funds rate hasn't changed. And the GDP actually has changed a little bit. It's up to 2.1 if I remember here. Okay, so what do we have here? So this period right here, okay, is very similar, almost, at least this latter part here, to what went on right here. So if the Fed is raising rates, then not to repeat ourselves, but it's certainly true that the Fed is raising rates. And it is certainly true that by that narrow definition of rates are higher, the Fed is tightening rates. The question we need to answer is the economic effect. Because the standard economic rationale for raising rates is that the economy is in danger of overheating, either on the generally on the inflation side, the inflation statistics, or no, okay, sorry about that. Okay, usually on the inflation statistics side. So let's go back and look at our inflation chart, which is right here. Okay, so this is core PCE, the Fed's preferred inflation measurement. I have long maintained that core rates are simply a bureaucratic excuse to perform better than they really are. Be that as it may, it's the one that everyone, my logic on that is simple. If you're looking for economic effect, then you should use the rate that has the greatest economic impact, and that, of course, is on the economy, meaning on the consumer primarily, and on businesses. Then you use the rate that everyone pays, and the rate that everyone pays is most certainly not the core rate. At least here in the States, we drive a great deal. Therefore, we use a lot of gas. Therefore, energy is a key. The cost of energy has a very important impact on our spending habits. Food. Does anyone here eat on a daily basis? I know it's kind of silly. Yes, we all do, mostly, unless we're dieting, of course. Therefore, food and the cost of food has a very important impact on on how we spend our money. Therefore, to conclude that these two items are not relevant to long-term trends and also to long-term trends in spending is, in my mind, preposterous. The only purpose of using a core rate is to make the monetary policy authorities look better. That is, on the idea, of course, which they have now surrendered, that inflation is too high. Again, the idea of core rate is based in a period back here and also much further back in the 80s, really, where inflation was too high. And so therefore, how do the powers that be make themselves look a little better? Well, they simply ignore a certain amount of inflation by calling it non-core. What hasn't served them a great deal of purpose lately, since for the past 5 years or so, the problem has not been by the Fed's analysis, not too little, not too much inflation, but too little. Therefore, the core rate is not doing them any good. Okay, so here's the headline rate. Also from the PCE, courtesy of the Bureau of Economic Analysis, I believe. Okay. So this rate has been rising for the past year, 2 years, pretty much, 15 and 16. And it's 2.1%. That's pretty much the first time since 2012 that we've been back to the Fed's target rate of 2%. I have spoken about my opinion. I have voiced my opinion on the idea of targeting inflation and targeting, how should we put this? Assuming the, I would call it Orwellian, but that's really too grand a title. The idea that the target rate, the base rate, the neutral rate of inflation is 2%. By definition, that is wrong. The neutral rate of inflation is 0 by definition. The Fed may want it at 2%. The reasons for that are obscure. Although, in my opinion, I believe they are connected to the overriding amount of Fed and global debt, government debt in the world. There's very little economic evidence that I'm aware of. Now, there may be, and there probably are many things that I haven't read because I'm not an economist, but I'm not aware of any convincing argument that the economy grows better with 2% inflation. Nevertheless, that's the Fed's target. So we'll just leave it alone and accept the Fed's target. So we have two questions in front of us. As far as the Fed, is the Fed really tightening rates? Meaning, will the economic effect, no, let's go back a little bit. Is there going to be a likely economic effect from this current bout of Fed increasing rates? Let's take another look here. Okay, let's go to GDP. Okay. Now this is, what do we have here? Let's not do that. Let's do just strict GDP. Okay, Fed funds GDP. And this is in the terminology that we're all familiar with, not the absolute amount of GDP, but the annual rate. One thing that seems certain here, forget from the level where we are, which right now is 1% on the Fed funds top target rate. Came up from 0.25 in 3 rate hikes, okay, over 3 years. If we ignore the absolute, I know this is a thought experiment. If we ignore the value, the absolute value of where the Fed funds rate is at 0.1%, 1%, just taking the idea that the Fed is raising rates in an economy that's growing at a certain amount, would the Fed be raising rates in an economy that's growing somewhere around 1.5%? Because this went up to 2.1% on revision last week, and the first quarter is tracking at 1% in the Atlanta Fed GDP Now track. That gives us a 6-month run rate on GDP of about 1.5%, a trifle more. In any other circumstance, would the Fed be raising rates with a 1.5% 6-month GDP? I challenge you to find me an instance of where that is the case. So, we can draw two conclusions from this. They don't necessarily agree. One is that the Fed is concerned about something else, and it's such a great concern that they are willing to risk essentially a recession by raising rates. Two, and I think this is more likely, is that the Fed has finally realized that at this level of rates, changes in rate structure don't have any economic effect, or very little. The problem with this logic, of course, is that it works backwards as well as forward. That means if the Fed now is not terribly concerned about raising rates because it finally figured out that it's not going to have any effect. This is my idea of the quantum bound in interest rates, which I will talk about in the Fed funds rate, which I'll talk about in a minute. I've mentioned that before, although not recently. That is that it also didn't really have any effect here. This period here from 2008 to 2006, 2015, and really beyond. That the logic of what the Fed is doing right now only has two possibilities. That they're more worried about something else, or they know it doesn't make any difference. There isn't any other answer. Because you have to assume that if the Fed knew and assumed that logical rate policy assumption that's always been true, that increasing rates reduces economic growth, then how can the Fed be reducing rates with increasing rates reduces economic growth with a lead time, of course. Then how can the Fed be raising rates with the economy growing 1.5%? Is the Fed purpose to reduce economic growth below 1.5%? How much farther can you reduce it without ending in a negative quarter, or horror of horrors, 2 quarters, which would, of course, be a traditional recession? So either the Fed is worried about something else. Now, what else could the Fed be worried about? Well, they could obviously be worried about inflation. Whoops, sorry. And let's look at their core rate. Okay, this is their core rate. So over the past year, you have gotten a substantial rise from about 1.25%, a little bit more, to 1.8 in the PCE core rate. Now that's a pretty substantial increase. Remember, this increase back here was largely, because these are year-to-year figures, this increase back here is largely predicated on this fall. So you have to get beyond a very steep increase or decrease before you can have a little more sense, a little more direction made out of year-to-year figures. But okay, given that, What appears to be happening here, if you look at this period here, right, from the last quarter of 2015 up until now, the first quarter of 2017. Okay, that's a pretty reasonable increase and over a year. The thing is, two things. One, a almost similar increase happened back here. And the Fed did not at all get from 13 to the beginning of 14. Same time period, similar increase. Not quite as much, but similar. There wasn't a hint, really, of the Fed increasing rates in those times. So what happened? Now, we also have another factor here. It has topped out at the same rate, 1.8% that we saw in 13, in 14, in 16, and now in 17. There is a pattern here. So again, this inflation scenario is hard to interpret as a fearful inflation scenario, one that the Fed needs to mobilize about to raising rates in December and then 3 months later in March. A little bit less, actually. Now it's 3 months. What else is going on right around here? What is the basic industrial commodity? Well, we all know it's oil. What have we seen dramatically? Might be time to have another webinar on oil. But what have we seen dramatically? A complete change due to the shale technology in oil production. Very soon, the United States, if not there already, I don't think it is, will be the largest exporter, or could be the largest exporter of shale oil in the world. This is impossible to believe 5 years ago. I do recall someone in power saying we cannot drill our way out of high oil prices. Now, that has been proven to be completely incorrect. We had, in fact, and have, in fact, drilled our way out of high oil prices. Shale oil is the basic, not shale oil, but oil in general is the basic industrial commodity. What will a permanent cap at 50, and I think probably lower because the remarkable advance in shale oil technology here in the United States and in Canada, anywhere else around the world too, wants to use it, has brought, as they call it, the break-even price of a well down to somewhere south of $40 a barrel and declining. It turns out a new technology is, surprise, surprise, very amenable to improvements in efficiency. In case anyone has, and I'm being sarcastic here, of course, but in case anyone has noticed, airplanes now fly faster than they did when they were invented. And trains got faster very quickly, and all sorts of other things. Technology routinely improves. So when shale oil technology, fracking, was invented, it became very quickly an improved technology. So wellhead price in the US is probably down to like $35 a barrel in many places now. Well, what does that mean? Well, that means that any well can make money at $35 a barrel or more. So you have, and there's an enormous amount of shale oil in the United States and everywhere else around the world too. So this whole idea, which I did a webinar on a couple of weeks ago, peak oil, is once again nonsense. You can, in fact, drill your way out of high oil prices. So if you have inflation going from here to here, but you have from 1.25 to 1.8 over the years period, it's pretty reasonable increase. I mean, here we went from 1.3 to 2.4% over 4 years. So it's about the same pace. But oil is a basic industrial commodity, which means that it puts downward pressure on all prices. Not a lot, but it certainly will tend to keep prices lower rather than higher. So not only do we have this increase in prices here, which is similar to the price here, but, and this is the average here on the Fed funds. It's a yearly average on the Fed funds rate. So right now, I'm sorry, on the inflation rate. The Fed funds rate is here. Also, I apologize. The Fed funds rate is actually 1, which is right here. You'll know that. Not the 0.6 that's over here. This particular set of charts will only display at least I've only figured out, it's a new system for us, will only display the correct Fed funds rate on top target on the daily chart, not the monthly chart. I'm not quite sure why that is, but I'm still working on it. Anyway, Fed funds rate is 1%, as we know, not 0.6. So we have a indicator here. So remember, what the Fed is concerned about is that inflation expectations, that nebulous idea of what people think inflation is going to be. I've always thought that watching Fed funds consumer expectations is a waste of time. The Fed doesn't know where inflation is going to be because they've been wrong almost the last 10 years. Every time they make a prediction, you're getting a look at their bureaucratic hope rather than their policy hope, rather than the actual statistic. So if the Fed can't get it right, how does anyone expect consumers to get it right? In fact, the only market which makes an appreciable success at predicting inflation is the credit markets, and that's obvious. They have money on the line there. So, if you want to look for the futures in the credit markets to see where inflation is going to be with a reasonable approximation of success rather than either the Fed's own projections or consumer expectations. But the Fed's concern is, inflation expectations don't get out of control. Okay. So we're not talking about the inflation now, we're talking about inflation 6 months from now or a year from now. Well, if one of the basic adjustable prices that consumers pay a great deal of attention to, and whether or not they're going to start agitating, and the problem, of course, with what the Fed's talking about is not simply the food price and the inflation price, but it's the cycle where, because of rising prices, people start demanding wage increases. The problem with that idea, of course, is that with the enormous amount of underemployment in the country, historically speaking, a 4.7% inflation unemployment rate doesn't mean a whole lot. And the underemployment factor, the U9 report, which is about 9.5, if I remember the last time, and we get a new report this Friday, will do the same thing as shale oil. It will cap inflation demands. If the market is oversupplied with labor, and how do you know it's oversupplied with labor? Well, look at wage increases. If there are no wage increases, it is telling you there's a reason, or very little. And what is the reason? The reason is employers don't have to offer it. Employers, being good business people, the ones of them that are, don't pay their workers more than they have to. It is a basic law of capitalist economics. So if they're not paying their workers more, that means they don't have to. The cap, or the inhibition on wage increases, comes from the large pool of underemployed and unemployed. Remember, the government statistics on unemployment are essentially phony. They restrict the criteria severely so that large numbers of people who are in fact unemployed and or part-time employed and want full-time employment are simply not counted. I'm sure many of you know this, but I'll repeat it. The unemployment rate that the government calculates, the 4.7% rate, means, its definition is that in order to be counted in that rate, on their survey, their household survey, you had to have looked for work in the prior month. The U9 rate, that's the U3, says in the prior year. To my way of looking at human reality, after being out of work for a number of years or a certain amount of time, one gets discouraged. Having looked for jobs in my life, it takes a great deal of effort and energy to get up and do this because one tends to get rejected a lot. And that's discouraging. Therefore, there are many, many people out there who would work were it easier to find a job wherever they are, but they're not counted as part of the unemployment rate. So the unemployment rate, the U3 that everyone quotes at, and government officials love to say, oh, look how low it is largely nonsense. Because if you want to see the impact of the labor market, look to wages. And if wages are not creeping up, that means employers are not having to pay workers more, which of course is their choice. Okay, so the Fed is concerned about inflation. And in a minute we're going to look at GDP as well. The Fed is concerned about inflation. It's concerned about inflation expectations 6 months from now, a year from now. Well, if the basic industrial commodity, now granted, as I said, there has been some increase here. Granted, and you have to grant that, okay? So, but as I said, to repeat, there was a tremendous increase in inflation here. Now, granted, it was because of this, but here as well, in this period of time, the Fed was raising rates. This inflation, 2003 to 2007 almost. The Fed raised rates, this graph line here, along with that. But again, the Fed funds rate got to 1.5, but it came from a period where the Fed funds rate was over here, 2.5 to 3%. Remember, my thesis is that below, at 1% or below, or maybe 1.5% below, as a top rate, the economy behaves differently. It does not respond to rate changes when the Fed funds rate is around 1% or lower. Okay, so from here to here we have increases, the Fed didn't do anything. From here to here we have increases, the Fed didn't do anything. From here to here we have an increase, and suddenly the Fed is all worried about inflation. It also topped out here. And this is with a 6-month view of very little wage inflation, telling you that the labor market is not at full employment. I don't care what the unemployment statistics say. Also, shale technology putting a cap on oil prices, the basic industrial commodity. Both of those are making it less likely, I would say unlikely, that you're going to get any sort of inflationary urge working its way through the economy. Don't forget, what have we seen? Now, this doesn't apply to food, but of course the Fed doesn't care about food, or so they say. Food prices are transitory. I never bought how food prices are transitory, but again, this plays to the Fed's notion of what they're performing for and their own bureaucratic measurements. You know, they talk, Chinese statistics are often criticized because they're only providing what the mandarins, the Communist Party mandarins in Beijing want to see. Well, I fail to see how there's a great deal of difference. I'm not making a comparison between two economic systems. When you alter over time, the unemployment statistics have been altered several times to make them more amenable. Of course, there is more theoretical justification, but the result is very similar. It produces statistics that are better conforming to the policy goals of the bureaucratic institutions that order them. Okay. So we have inflation of, and one other factor, the entire history of the past 10 years has been one of deflationary pressures. The other great factor in deflationary pressures has been the overbuilding of the resource and manufacturing sector. Not so much here, but overseas. The great advent of the manufacturing power of China. They may be transplant factories, but they're still churning out goods. The resource development, if you look, and we've looked at this in the past on commodities, the long-term decline in the commodity pricing is largely due to, again, the same thing as the oil. High prices are the cure. The cure for high prices is high prices. The resource sector developed mines and processes for obtaining natural resources, on the idea that one, prices were high and we'll make a lot of money, and two, that there will be forever increasing demand because of China and the rest of the developing world. Well, neither one turned out to be the case, yet those mines, like the shale oil wells in the United States, remain, and the people who invested them are eager to produce. So what do? Well, they try to get their production costs lower and lower and lower. Because why? Well, then they can make more money at a lower price. So you have this rather profound and inherent in the development of industrial economies from, let's put it this way. If a country wants to develop wealth for its people, what does it do? Well, it develops mines and resources and attempts to sell their products to the rest of the world, therefore bringing money home. China has done this enormously successfully. So have most other countries over time, only over a longer period. But what is the result is something the economists love to point to when they talk about NAFTA and other arguments. Well, the reduction in consumer prices is a greater good than anything that went into that. And that's another topic, one that maybe we should cover. At any rate, so the trends in the world economy remain at the very best price stasis, not inflationary. You have resources and commodity prices lower as a trend, as a very, very profound trend over time. You have overdevelopment of resource, of manufacturing, and you have basic industrial commodities, meaning oil, lower. You don't have any evidence of wage inflation. So all of these factors, looking ahead, don't predict higher inflation. Yet the Fed is suddenly terrified about inflation. Now, let's look at one more thing, the job market. Well, let me make a little summary here on this. It is my contention, as I said earlier, that two things are happening here. Because as has been true of this entire period from 2010 on, this is, what do we have here? It's inflation. Let's look at GDP. Here, this one. Whoops, GDP. Okay? A proxy for all sorts of things. Okay, so inflation, we're seeing that there isn't any particular change in inflation in the past 2 years, really, that in the past the past meaning the current world, after the financial crisis, has inspired the Fed to raise rates. So let's look again here. See if I can find a Fed funds with an average. That's not it. Let me just bear with me for a second. Remember, I'm using slightly old No, that's the Dow. Sorry, I don't think I could get the right chart here today. I apologize. Let me just check that one. Okay. We're going to have to go with this chart because that's what I've got today. As I said, I had a few issues with my information system here today, and I couldn't get up the new number of charts that I wanted to. I had to use some old ones. Okay. So this period here, this is GDP. Remember, we just looked at inflation. And for the past decade, since the financial crisis, there's very little logically that is telling you either in inflation, the rate itself, despite the steep rise, relatively steep rise in the past year, or in the factors going into future inflation that we just went through, commodities and industrial process and manufacturing, and wages as a indicator of all these, that really indicates a change in inflation expectations. No one's agitating for wage increases because they can't get them. Okay, so we don't have an inflation picture which seems to be predicting a need for the Fed to start raising rates rather rapidly. So let's look at GDP. There is zero that I can read here, looking at my chart, indication that the economy is overheating. Where? How? By what measure? 1.9%, and then we're down, remember, 1% in this quarter, which of course could be a mistake and it's only an estimate. But our best information right now, and for the past, since December, when the Fed raised rates, is that the economy is running at 1.5%. How is that an overheating economy? Well, the answer is relatively obvious. It isn't. So where is the Fed looking? Where is the Fed looking? Remember, we've been dealing with the Fed, which told us for years, and I know it's very easy to criticize the Fed. I'm guilty of that, as many other commentators are. It's much harder, or as Teddy Roosevelt, it's the man, I guess, or the woman nowadays, who is in the arena who deserves the credit. And the Fed and its governors are, in fact, in the arena. The arena is both economic and bureaucratic, but they are the ones who actually have to make the decisions. So credit to them. Nevertheless, we are obliged to offer our analysis as well. Look at this chart of the annual, the orange is the annual, or the annual rate, the quarterly annualized rate in US GDP. Okay, here, back here in the 90s, we had a couple of periods here where it's 5 and 6%. So yeah, the Fed starts raising rates, and it looked like they're a little, and then they raised them even higher. Went here and went even higher, and then we got this recession 2001. Okay, and then it came all the way down. And look at the chart on this. The Fed rates have been going lower since the Paul Volcker days. Inflation has the same cast. The Fed had always assumed that the reason inflation has come off is because of their success in squeezing out inflation expectations due to their change in rate policy and targeting inflation. Now, there are other possible explanations for this, such as some of the economic, industrial, resource, and, if you will, demographic changes that have taken place over the same period. Because remember, during this period here, China was, entering into the great boom. Demand flowing from everywhere. The main effect on demand, as far as in the United States, has not been to boost U.S. economic growth through trade. If that's on this chart, I don't see it. So one of the effects has certainly been a change and a displacement in the world, in the overall world economy. However, again, as with inflation, looking at this chart, there is zero sense that the U.S. economy is overheating. As I said earlier, in what other economic era, E-R-A, rather than E-R-R-O-R, error, slightly different, I suppose, would the Fed be raising rates a potential 1% increase over an elapsed year, a steep increase? Let's see here, 2004. Let's take here's the rate over here, okay? So we got to 1% at 2004, that's 1.5, 1.25. Where's 2%? 2% is right here. So basically in a year, it went up 1%. Well, that's exactly what we're looking at here, potentially. But the US economy was going from up to 3% and then up to 7 and 8%. And the average was somewhere around 3% or more. I mean, I don't have the average on this. Or look at this one here. We have the economy growing, let's see, before the Fed starts raising rates, we have the economy growing 1%, then 3%, then 4%, then 4.5%, goes down again to, what's that, 2%, and then back up to more than 4%. So that's what got the Fed hiking rates here, okay? And here, we had the economy bouncing around, but we had a 3.5%, then a 7.5%, then all the way, that's a recession here, down to 1%, and then back up to 6%. Okay, a little bit of volatility there. But that's what got the Fed raising rates. Absolute amounts matter when it comes to the economy. I mean, if the economy is down here, if you're looking at a logic here, so the economy is down, if you're only talking about the slope of the ascent of the economy from its bottom as the reason for getting the Fed to raise rates, then you have here from -1 up to 7, a very steep slope. So the Fed starts raising rates, okay? Well, take it over here. Let's do it before. So we go from here, which is 3, up into 7.5. So the Fed got excited and started raising rates. It's a very steep ascent, the slope of the economic growth. Well, you want a steep ascent? How about this one? -6 to 6. That's the steepest one, almost the steepest one here. Although there are some pretty steep ones back here in the early 80s. So if it's absolute slope, if it's slope rather than absolute growth level, certainly the Fed should start raising rates. I mean, look at that slope. But that's, of course, not the reason. And the fact that they didn't raise rates here is telling you that. It's not the slope, it's the absolute rate of growth. So the absolute rates back here are 3 and 3.5 and 4, peaking at 5 and 6 and even 7%. That's the kind of economic activity that got the Fed to raise rates. And you'll see changes in inflation as well, but I'm just dealing with this right now. So we do not have that type of economic activity. So from an economic point of view, why is the Fed raising rates? I'm looking for evidence here. Remember, this is the Fed, which said that it's, it's statistically based. No, it's not. Well, it may have been. In which case, it seems, although I haven't seen anything on this, anywhere that any of the Fed governors are even giving the slightest intimation that maybe they were wrong about the effect of low rates. That they don't have a profound economic effect. If the best army you can offer for a policy which is distortative, is that a word, distortative? Distortion inducing, shall we say, in the economy as 0 rates, and it is distortion inducing. If the best defense of that policy you can have is basically a thought experiment, it would have been worse, something that you can't prove, a counterfactual, then you should probably reassess your theoretical basis for this idea. I've said many times, and I would say it again, the Fed's main logic for reducing rates is twofold. But really, it's one. The Fed had to do something, and there's nothing else it could do. It's really that simple. If the Fed did not do everything that it could post-2008, it would have been accused, if not guilty, of the Fed's great modern policy error back in the Depression. And this, of course, is Mr. Bernanke's opinion, that the Depression was largely, if not caused, at least exacerbated by the Fed's incorrect tight monetary policy. I don't know that that's been proven. It's certainly been proven to Mr. Bernanke's satisfaction. But we have here the opposite side of that, the reverse of the medal, if you will, the reverse of the current coin, is that the operating assumption behind that logic is that the linear one, which I've spoken about a number of times before in several contexts, is the linear application of interest rates to economic growth. And it is my assertion that the linear idea is inappropriate beyond, say, lower than 1.5% in the funds rate for a prolonged period. I can't prove this. I haven't proved it because I'm not an economist. It's not what I do. But the evidence seems fairly conclusive that this is incorrect, because it follows out logically too. If the only thing that was necessary to produce economic growth was low rates, then how would we ever have anything but economic growth from low rates? And obviously it doesn't. There are many, many other more important factors in an economy and how it grows than simply low rates. If free money were all that was necessary to have a thriving capitalist economy, then we would have a thriving capitalist economy right now, and we don't. And that's true everywhere around the world. So clearly, the logic that proves that if 2% is good, 1% is better, and if 1% is good, 0 is better, if 0 is good, -1 is better, is incorrect, as common sense would tell you. So, back to the Fed standards. Inflation does not seem to be predicting a need for Fed rate increases for reasons we elucidated. GDP, this chart in front of us, shows a 0 indication of an overheating economy. If anyone sees an overheating economy here, please type it into chat and tell me where you see it, because I just don't see it. So, and we could say the same thing about jobs. And we can certainly say the same thing about wages. The traditional, the ones that the Fed talks about, not mine, the Fed's own statistical logic. Remember, we're based in statistics. That's all we do. We just respond. We're technocrats whose job here is to make the economy perform better. Well, the world is a more complicated place than that. So the reasons that the Fed would start raising rates: inflation, GDP, jobs, and wages. The only one that remotely, where you can make an argument that the Fed needs to raise rates, is inflation. And you can make the argument, I think it's an incredibly weak argument, because of the reasons I spoke about, both present and future. But there's no preponderance. There isn't even a balance. There isn't even a plurality of evidence that the Fed needs to raise rates. So the real question that I started with is the Fed tightening in the essential economic aspect? Remember, the Fed is not raising rates because the Fed wants to raise rates, because it's bored with rates at 0.25. That's not why the Fed is raising rates. It is ostensibly raising rates for their economic purpose. Well, if the economy doesn't need higher rates because it's, traditionally overheating, then why is the Fed raising rates? And is this a tightening cycle? Or has the Fed finally realized that low rates are detrimental to economic growth over a prolonged period, as I believe, and that sooner or later, and probably sooner because right now it's unexpected, there will be a recession, and the Fed does not want to be caught with a recession at 1% or at 0.75 or any of the other rates. These are not, now the Fed has said this, but not lately, and only sort of in passing. So from an economic point of view, the Fed is not tightening rates. In an economic point of view, the Fed tightens rates to head off inflation, to head off wage inflation, to head off an overheating economy, an economy that is going to, because it's not being addressed, build in an expectation of inflation. Remember, the last great battle the Fed fought before the financial crisis was the inflation of the 60s and the 70s. You must admit the Fed thinks in long terms, as it should. That was the last great battle the Fed fought and won. Although I say there's many more questions about why they won. Nevertheless, coincidence, they get credit, some credit anyway. They are unfortunately, and for understandable reasons, the only tool they have, the only weapon they have, fighting this current battle of low growth, and they would say low inflation, and no wage growth. And also remember, just to mention briefly, the government statistics on jobs. Those statistics include jobs created, part-time jobs. There isn't anyone who has a part-time job and trying to support a family or something else who is happy with that. So those figures are also fabricated to some degree, at least in the idea that the economy is bowling along because it's creating several 200,000 jobs a month. If you prorate those jobs to full-time employment, the numbers look quite different. And again, the evidence is in the wages. So anyway, back to the idea, which is the one we started with, is the Fed tightening rates? And I think the answer is no, they are not. At least by the understood traditional impact and reasons for raising rates, which is to rein in inflation, economic growth, overheating economies, on and on. The Fed is raising rates, but not really tightening. I know the logic is, it's trying to do time travel, Well, we're going to go back in time and change something, but then if we change something, we don't exist. The logic is circular. And here, of course, the logic is straightforward. If the Fed is raising rates, they are in effect tightening credit conditions. Although there is a very profound argument that credit conditions have already tightened. But either way, the semantic logic that the Fed is raising rates means the Fed is tightening is inescapable. That's one level. The level I'm discussing is the level of economic effect, both cause and effect, or reason and effect. And there, it's entirely lacking. There's no reason, or very little reason, on the economic statistical level for the Fed to be raising rates. Maybe the Fed has a crystal ball And they know that in the middle of next year, inflation's going to burst out and be running at 3 and 4%, and they need to get hold of that. Or that economic growth in 2018 is suddenly going to reach 6% for a quarter, and they know that, and they want to get a hold of that. Or in wage inflation is going to boost up to 6% again, and they want to get a hold of that. But I do not believe in the Fed's crystal ball. I don't believe in my own crystal ball. I don't believe in crystal balls. So there's nothing that I can see that logic is telling the Fed they need, economic logic is telling the Fed they need to raise rates. So the Fed are raising rates for different reasons. And so this is not an economic tightening cycle. Now, I do also believe that we will reach a point in the Fed funds rate where economic effects again begin to take place, where we leave the quantum world of zero interest rates and return to the Newtonian world, my favorite metaphor on this, of linear effects. But we're not there yet, and my guess is that doesn't even happen till we reach 2%. Okay, folks, I thank you very much for attending. I hope this has been useful. We will take up another topic next week. I'm not sure what it is yet. There will be an interview, another interview. We've done 3 so far in Market Directions interview. This Wednesday at 10 o'clock. The guest will be posted probably tomorrow, so I invite you all to join. And I hope you find this interesting, instructive, and maybe slightly humorous. Again, I will put my email address up there. If anyone has any comments or questions, please send me an email and I'll be glad to address it. Again, thank you all very much for attending, and everybody have a good day. Take care.